On Tuesday night, the 3rd of May, the Australian Federal Treasurer Scott Morrison delivered his first budget to the nation. This budget, whilst designed to continue the work on reducing the deficit, is about getting Australia to transition from a predominantly resources-led economy to be more of a diversified services-driven economy. It brings with it the most significant changes to superannuation and retirement planning since 2007, and these changes bear some discussion. I'll be producing a more comprehensive budget analysis piece that will be forwarded after this video. So what are the changes? Perhaps the change that has driven most of the discussion so far has been around the contributions caps, that is, the amount that people can put into superannuation concessionally. Currently, those under 50 can put in a maximum of $30,000 a year as a combination of salary sacrifice contributions and SGC contributions, and for those self-employed, the tax-deductible contributions that can be made. Those over 50 have $35,000 that they can contribute. The budget proposes that from the 1st of July of 2017, this limit reduces to $25,000 for everybody. It's important to take account of the $25,000 limit in planning from the 1st of July of 2017. That means we still have the remainder of 2016 and financial year 1 July 2016 to 30th of June 2017 to use the old limits. The other concessional cap issue that the budget puts in place is the ability for a person, whether they're self-employed or employed, to make a tax-deductible contribution to superannuation. Currently, those people that want to claim a tax deduction for their concessional contributions need to be substantially self-employed. That is, 90% of their income needs to come from self-employment, and no more than 10% can come from an employment relationship. The 10% coming, that requirement now has been eradicated, so everybody has the ability to claim a tax deduction up to the $25,000 limit. But those that are employed and have SGC and salary sacrifice can only claim deductions for contributions made over and above that. On the non-concessional contribution side, the changes are also fairly far-reaching. Currently, people can put in their after-tax money up to $180,000 a year, or bring forward 3 years of limits and contribute $540,000 if they're under 65. This might come about as a result of selling or downsizing a property, or having a business windfall or a sale of a business in preparation for retirement. The government is replacing that regime, and it is proposed that this comes into force from budget night, with a regime of a $500,000 lifetime limit. So people will be limited to $500,000 in their lifetime, and our understanding is currently that this $500,000 can be made as a one-off contribution and nothing ever further, or it can be obviously made over a period of time. The important thing to realise with this initiative is that any contributions on non-concessional side that have been made since the 1st of July of 2007 are caught against that lifetime cap. So what this means is that many people that have been pursuing a strategy of maximising super contributions using $540,000 every 3 years, or the maximised cap over the 3-year period, may have in fact gone over their lifetime cap already. Whilst there won't be any penalties for people that have already gone over their cap under the current rules, they will just be limited to not making any further contributions. The changes to contributions caps, both concessional and non-concessional, really impact a lot of strategies that we work with our clients on. You may in fact be following a strategy that is impacted by these changes. It is important that you seek some advice as changes might need to be made to ensure that you comply with the rules and avoid excess tax consequences. Transition to retirement allocated pensions or transition to retirement income streams are also changed by the budget proposals. There'll be a removal of the exemption from tax for income that is generated from transition to retirement pensions, putting this strategy in a bit of doubt as to its effectiveness with people going forward. Again, advice towards your personal circumstances will be required. Also removed is the anti-detriment payment. This payment comes about on death benefits, the taxable component of death benefits out of superannuation, and it reflects a rebate or offset that the superannuation fund gets from the ATO, where the person has had contributions tax taken from their superannuation by means of the SGC and salary sacrifice that has been made through the years. Many superannuation funds pass this rebate on to clients in the form of an additional payment on top of the death benefit to compensate in some way for the tax on the taxable component when monies are paid out to the estate. Now, without anti-detriment payments, there won't be that additional amount that will be able to be paid out with death benefits. The government have highlighted that it is very difficult for a smaller superannuation fund, such as a self-managed super fund, to pay out to a beneficiary before they actually get the money in from the rebate. Hence, there is an inefficiency in the system that this initiative is designed to remove. The other impact with regards to pensions is the introduction of a cap on the amount that can generate tax-free income for people. Currently, any amount of money can be put into the superannuation environment and then into an account-based pension, and people that are over the age of 60 will enjoy tax-free income. It is proposed that from the 1st of July of 2017, the amount that can be transferred to a tax-free income from an account-based pension will be capped at $1.6 million. Any amount that is over $1.6 million will be generating income generating a pension where the income is actually taxed. So there will be the opportunity for people that have existing account-based pensions where there's more than $1.6 million to withdraw the excess and bring that account balance under the cap, or alternatively they will be taxed on the income on the amount that's over $1.6 million. So there have been a wide variety of changes that have been proposed in this budget. They do have some significant impacts on people, and it is important now that people assess how these impacts affect you. We're standing ready to assist our clients and anybody else that wants to discuss how the budget changes impact their situation, and we would love the opportunity to sit down and talk these matters through with you. It's important to realise from a broader context that what the government has proposed really only scratches the surface of addressing our deficit problem. We have a deficit that will continue now, It is projected to have a 12-year run of deficits, which is the longest run of deficits that we've had for a significant amount of time. The important thing to realise is a need for further reform has been pushed down the road and not taken on in this particular budget. Many people are calling for a broader based collection of taxation, and in particular looking at the GST rate and further taxes on account-based pension for those in retirement. It is unlikely that we will see the political will of either party to address these matters in any real form anytime soon, and this is a disappointment. We'll continue to agitate and lobby for a more broader approach to taxation. And in the meantime, we wait with interest to see what the election in July will bring and its impact on financial planning and the wider wealth management approach that we take with our clients. If you'd like to get into contact with us, our details will be at the end of this email. Thanks very much.